a death sentence at 6:30 p.m. on Friday. The United States Treasury has just ordered a ban on Canada using the US dollar. Mark Carney is not just pushing back. He is shattering the illusion that the dollar is a safe and neutral haven for everyone. What the Canadian Prime Minister declared within 48 hours of the Treasury Directive may have permanently changed the global financial system. And Warren Buffett has just issued the most shocking warning of his career. When the Oracle of Omaha labels this action by the Treasury, you will understand. This story is not for Canadians. It is about whether the dollar can survive what is happening from within. Do not look away and hit subscribe now, because the financial system has just cracked, and you need to understand how far those cracks are spreading. Let me tell you the details of what happened, because they are almost unbelievable. Last Friday night at around 6:30 p.m. Eastern Time, the hour when Washington usually announces information they want to bury, the Secretary of the Treasury signed Executive Order 2026-0147. They chose the darkness of Friday night because they knew exactly the gravity of the matter. They are cutting the lifeline of an allied nation. This directive restricts Canadian government entities and Canadian state-owned enterprises, including the Bank of Canada and state-affiliated financial institutions, from accessing the US dollar clearing system. Washington is pulling the plug on the entire economy of their neighbor. The targets are two hearts of the world financial system: CHIPS, the clearinghouse interbank payment system, and FedWire, the Federal Reserve real-time gross settlement system. This is where the money of all humanity flows. CHIPS alone processes $1.8 trillion in transactions every single day. That number does not lie. And now Canada has 90 days to restructure, a fancy bureaucratic term for find another way to live because we are cutting you off. The truth is, the United States just told Canada they can no longer use this currency. No government trade, no state enterprise transactions, no central bank operations. Look at the price. $120 billion of Canadian energy exports every year now face the abyss. Export Development Canada, the unit that finances Canada's trade worldwide, has lost its primary payment mechanism. The geopolitical trap is snapped shut. The consequences of this geopolitical trap do not stop at export numbers. It is piercing directly into the pockets of every citizen.
The Canada Pension Plan Investment Board, which manages over $500 billion in pension assets for 20 million Canadians, is facing immediate trouble with its dollar holdings.
This is not a tariff. This is not a common trade barrier. This is the financial equivalent of cutting off someone's blood supply and calling it a compliance check. The investment portfolios of millions of workers are evaporating because of a single executive order. The justification from the administration of President Donald Trump is what makes this truly extraordinary. The United States Treasury cited Canada's CEO trade agreement with the European Union, the CSA Commonwealth Treaty, and the CSC Energy Bypass Infrastructure's activities inconsistent with the dollar's role in bilateral trade. This directive accuses Canada of making systematic efforts to undermine the position of the US dollar in international trade. They view diversification as a betrayal. And look at the legal basis. The International Emergency Economic Powers Act, or IEEPA. The very law the United States has used to punish Iran and Venezuela. Reflect on that for a moment. The United States just used the same legal authority meant for hostile nations to restrict financial access for its closest ally. Its largest trading partner, a member of NATO, an intelligence partner in the Five Eyes Alliance, and a democracy belonging to the G7, the political map has been torn apart. The same legal mechanism designed to punish nations that threaten American national security is now applied against a country that has fought alongside America in every major conflict since World War I. But here is why this is even more dangerous than it appears. Dollar payment restrictions have been used against adversaries for decades. Iran was cut off in 2012. Russia faced escalating restrictions starting in 2014, and again after 2022. North Korea, Venezuela, Syria, Myanmar, all have suffered this financial death sentence. But Canada is not the enemy. Canada is a member of the G7, a founding member of NATO, the largest trading partner of the United States, a Five Eyes ally that stood shoulder to shoulder in Korea, Afghanistan, and Iraq, a democracy with one of the strongest rule of law frameworks in the world. Yet here we are, for the first time in the 80-year history of the Bretton Woods system, dollar clearing restrictions have been applied to an allied nation. For for the first time in history, the system has cracked. The reaction from experts has been swift and severe. Former Treasury Secretary Larry Summers, who served under President Clinton and is one of the most respected financial policymakers today, called this directive the most reckless use of financial sanction power in American history. He said it plainly. You should not weaponize clearing access against allies unless you want to destroy the system. That is the foundation of clearing access. This is not punishing Canada. This is punishing the dollar. A former executive director of the IMF, speaking anonymously, called this an act of financial self-harm disguised as a sanction. The institutional credibility of the entire dollar clearing system has been damaged. These cracks cannot be healed with polite diplomatic promises. It is a time bomb placed right under the feet of every investor holding American assets. And that bomb is not just in the numbers. It lies at the very root of existence. Kenneth Rogoff, a Harvard University economist and former IMF chief economist, whose research on currency dominance is considered definitive in academia, said something that goes to the heart of the matter. The reserve status of the dollar depends on one thing. The belief that access is unconditional and non-political, that belief just died, and beliefs once killed cannot be resurrected. The wave of condemnation keeps rising from the very highest elite. Former Federal Reserve Chair Janet Yellen, in a rare public statement, said she is deeply concerned about the precedent this sets for the integrity of the U.S. financial system. Mark Carney's predecessor as governor of the Bank of England, then Ben King, called this directive from the administration of President Donald Trump the most dangerous act of financial policy he has witnessed in 50 years of central banking. This fracture cannot be covered up. Mohammed Al-Arian, the chief economic advisor at Allianz, and one of the world's most watched financial commentators, wrote in the Financial Times that the Treasury just gave every finance ministry a reason to flee dollar dependence. When too many former central bank governors, finance ministers, and IMF officials publicly condemn a directive within 24 hours, that something is fundamentally wrong. This is not partisan criticism. This is a distress signal from global finance. The reserve status of the dollar is built on trust, not law. There is no treaty requiring other nations to use the dollar. There is no international obligation forcing central banks to hold dollar reserves. Yet 59% of global foreign exchange reserves are held in dollars because nations trust that the dollar will always be available, always liquid, and always usable without political conditions. That trust is the most valuable economic asset the United States owns. It allows America to borrow at lower rates than any other nation. It allows America to maintain persistent trade deficits. It allows America to project financial power across every continent. And that trust was just shattered because if dollar access can be revoked for Canada, a G7 nation with a perfect credit rating and no history of financial wrongdoing, then it can be revoked for anyone. Every monetary policymaker on earth just witnessed the United States revoke the dollar rights of its closest ally, simply for the crime of signing trade agreements with other nations. All of them are now asking the same question. Am I next? The answer to that question no longer matters. What matters is that the question is being asked. A reserve currency accompanied by political conditions is no longer a reserve currency. It is a burden. It is a trap. It is a suspended sentence. The Treasury gave Canada 90 days to wind down dollar access. But Mark Carney used only 72 hours to make the dollar irrelevant. Receiving the notice on Friday night, by Saturday morning he had convened an emergency cabinet meeting with the Minister of Finance, the Governor of the Bank of Canada, and the Ministers of Trade, Natural Resources, and Foreign Affairs. By Sunday night, the strategy was finalized. And by Monday morning, Carney stood on Parliament Hill, delivering a 28-minute speech televised nationwide. It was a calm, precise, and deeply persuasive speech. He opened with a line that will be studied in diplomacy history classes for decades. The United States has just proven to the world that the dollar is not a neutral financial tool. It is a weapon, and once a weapon is drawn, it changes every relationship in the room. Carney called this directive the most serious strategic mistake in American financial history. He did not wait. He did not plead. He outlined a 5-part counterattack plan that made the Treasury's 90-day deadline look like a lifetime. The first move, activate the Euro CSF payment mechanism Immediately, the activation of the Euro CSF mechanism is not just a declaration. It is a large-scale financial evacuation. The entire annual bilateral trade between Canada and the EU, worth $98 billion, will switch to euro payments starting that very day. Not next quarter, not after a transition period, but immediately. Second, Mark Carney has accelerated the rollout of the CXA Commonwealth multi-currency payment platform. The original 18-month plan was torn up to be replaced by a full deployment roadmap in just 60 days. 34 participating nations with an expected $1 trillion in annual transactions, all conducted in non-dollar currencies. No more CHIPS, no more FedWire, and certainly no more control from Washington. Third, and this is the announcement that truly startled the financial markets, the Canada Internationalization Program, or CIP. The Bank of Canada will begin issuing bonds secured by the full value of Canada's energy reserves, mineral rights, and agricultural commodities. These are not your typical government bonds based on a promise. They are instruments backed by physical assets, offering investors a real alternative to U.S. Treasury bills. Look at what stands behind them. The Alberta oil sands, with the third largest reserves in the world. Saskatchewan potash, accounting for 30% of global supply, timber, and liquefied natural gas from British Columbia. The massive hydroelectric capacity of Quebec, the strategic mineral deposits of Ontario, and an agricultural sector that feeds over 100 countries. The goal is to issue $200 billion in bonds within the first year. And look at how the world reacted. Within 6 hours, the Bank of England, the European Central Bank, and the Reserve Bank of India all expressed significant interest. A senior official from the European Central Bank told Reuters, "We have been waiting for a reliable commodity-backed sovereign financial instrument that is not priced in dollars." Canada did not just save itself. They just built a new harbor for global capital. For 80 years, U.S. Treasury bills were the default safe asset. But CDIP has changed the game. For the first time, the world has an option supported by physical goods, rather than faith in a government that just proved it is willing to use finance as a weapon against its own allies. Fourth, the Bank of Canada announced emergency bilateral currency swap lines with Britain, Europe, India, and Japan. The total swap capacity reaches $340 billion in non-dollar liquidity within just 72 hours of the ban from the administration of President Donald Trump taking effect. Canada possessed more foreign currency liquidity than most G20 nations. And finally, Carney delivered the finishing blow, an emergency summit for any nation that fears American financial coercion. The guest list ranging from the European Union, Britain and India, to Brazil, Japan, and the ASEAN nations. It reads like a roll call of entities wanting to escape the grip of the dollar. All of them accepted within 48 hours. The financial map is not just cracking, it is being completely redrawn. He was not angry at all during his speech. In fact, he was almost grateful because that very ban gave him the one thing he could not create on his own. A legitimate reason that every nation on earth would accept without question. Look at the shift on the chessboard. Before the directive from the administration of President Donald Trump, the moves by Canada to de-dollarize could have been seen as aggressive. After the directive, they were viewed as pure self-defense. The numbers do not lie. Public support for the response from Carney reached 91%, the highest for any policy action in modern Canadian history.
The Toronto Stock Exchange surged 2% on Monday as investors priced in the appreciation of a commodity-backed currency.
The Canadian dollar strengthened 2.1% against the US dollar, the sharpest one-day gain in over a year. The ban was supposed to isolate Canada. Instead, it turned Canada into the leader of a global movement. And then came the reaction that changed the conversation permanently. The statement from Warren Buffett was released on Monday evening, just hours after the speech from Carney. In a response published through the Berkshire Hathaway Investor Relations page, the 94-year-old billionaire issued 3 lines that made up the harshest public condemnation of American financial policy he has ever given in 6 decades. He said, "I have spent 60 years telling anyone who would listen that the US dollar is the safest store of value in the world. As of this weekend, I can no longer say that with absolute confidence. And if I cannot say it, then surely the central banks of the world cannot either." He then called the weaponization of dollar clearing against a close ally the most self-destructive financial decision since Nixon closed the gold window in 1969. Nixon's decision ended gold convertibility. This decision could end the indispensability of the dollar. And finally, he stated that the strength of the dollar was never about the military. It was about trust. You just told every nation on earth that trust is conditional. That was not a sanction against Canada. It was a sanction against the dollar itself. I need you to understand the gravity of what just happened. In 60 years of public statements, Warren Buffett has never doubted the safety of the US dollar. His entire investment thesis, the foundation of the greatest wealth-building record in human history, was built on the belief that American financial stability was permanent. Berkshire Hathaway holds over $300 billion in US Treasury bills. He is not a commentator. He is a man with 300 billion reasons to want the dollar to hold its strength. And he just publicly told you through an official corporate channel that the dollar has been undermined by its own government. When Warren Buffett says he can no longer fully guarantee the dollar, the entire global financial system will recalibrate, not just because he moves markets, but because his credibility is absolute. If Buffett has doubts, those doubts are real. And then Buffett revealed something that sent a shockwave through the markets. Berkshire Hathaway has been reducing its holdings of US Treasury bills over the last 18 months. The company moved $40 billion into Japanese yen assets, including significant positions in the 5 major Japanese trading houses. The company has increased investments in Canadian energy firms, European financial services, and Indian infrastructure. And the most incredible detail of all is that Berkshire recently began accumulating gold. This is the first significant gold position for Buffett since the 1990s. Understand this. Warren Buffett buying gold is like a vegetarian opening a steakhouse. It is not just a portfolio change. It is the collapse of a faith. The pivot from Warren Buffett is not just a shift in a portfolio. It is a major surgery on faith itself. For decades, this man has publicly mocked gold as a useless pet rock, a non-productive asset that just sits there and stares back at you with a blank gaze. In his 2011 letter to shareholders, he joked that if you melted down all the gold in the world into one giant cube, it would not be worth as much as all the farmland in the United States, plus 16 ExxonMobils combined. He believed in things that create value, not things bought out of fear. But look at what is happening right now. Buffett, the most powerful anti-gold voice on the planet for 60 years, just quietly reversed his entire position through SEC filings. When Buffett buys gold while dumping the dollar, he is no longer just investing. He is signaling an evacuation. Gold is what you buy when you no longer believe in the currency. And Buffett just admitted that his faith has been shaken. An anonymous member of the Berkshire Hathaway board revealed a comment from Buffett that chilled the financial world. The reserve status of the dollar has moved from permanent to maybe, and you know that in the world of numbers, maybe is the first chapter of an end. Markets never price in doubt slowly. They punish uncertainty immediately. The man who spent his life betting on the destiny of America is now silently building an escape hatch for his empire. That is not a hedge. It is a death sentence for the greenbacks monopoly. And here is the most devastating boomerang effect that the administration of President Donald Trump did not foresee. This ban did not strangle Canada. It is only strangling the US dollar itself. Canada was not passive. They have been silently building a financial fortress away from the dollar for over a year. The euro CSF system has opened the doors to euro payments. The CX, a Commonwealth platform, is ready with alternative currencies. Their energy pipelines have found other routes, leaving the United States on the sidelines like an uninvited guest. The ban did not break Canada. It was the spark that accelerated an exodus that was already prepared. Within just 72 hours, Canada held $340 billion in liquidity from swap agreements and the support of 34 Commonwealth nations. Washington wanted to use the dollar as a chain to punish, but Canada broke those chains in a single weekend. The price America paid is an instant catastrophe. The US dollar index evaporated 2.3% in just 48 hours, the worst free fall in 3 years. As foreign investors began to flee, 10-year Treasury yields spiked 22 basis points, dragging mortgage rates higher and snapping our already fragile housing market. Look at these numbers. $84 billion in foreign reserves fled the United States in just 1 week. To give you perspective, this is 3 times larger than the outflow during the peak of the 2008 financial crisis. Even our largest creditors, China and Japan, holding a combined $2 trillion in U.S. government debt, are holding emergency meetings to evaluate if Washington's IOUs still have any value. J.P. Morgan issued a harsh but accurate assessment. The Treasury did more damage to the dollar with one directive than all of BRICS achieved in a decade of effort. And Goldman Sachs warned that if this continues, the dollar's share of global reserves will fall below 55% for the first time in history. Morgan Stanley told their clients plainly, political risk is now nailed to the value of the dollar. And the only way to survive is to move your money out of dollar-denominated assets immediately. The collapse of the dollar is not because Canada left. It is because everyone else on the planet has started asking themselves if they should be the next to leave. And in the world of currency, when you start wondering, you have already effectively stepped out the door. Trust does not erode gradually. It collapses like a domino effect. And the first domino has just fallen. Look at the self-inflicted wounds right on Wall Street. Giants like Citigroup, J.P. Morgan, Goldman Sachs, and Bank of America lost billions of dollars in expected transaction fee revenue overnight. These banks live on the lifeblood of dollar flows between the two largest trading partners in the world. By cutting off access for Canadian government agencies, Washington did not just hurt them. It directly picked the pockets of American financial institutions. This pain is spreading to every factory floor and every farm across America. Our exporters, with $350 billion in annual trade to Canada, are now facing currency conversion costs and payment delays. An auto parts manufacturer in Michigan, who has billed in dollars for 40 years, suddenly finds himself negotiating to accept payments in euro or Canadian dollars. This complexity and uncertainty is shredding business relationships that have been seamless for decades. Multiply that by tens of thousands of American companies, and you see an economic disaster taking shape. Midwest farmers, the backbone of America, are being dealt a fatal blow. $38 billion in annual revenue from grain, cattle, and dairy sold to Canada has been turned upside down. The American Farm Bureau Federation issued an emergency statement calling the directive from the administration of President Donald Trump a direct threat to the livelihoods of farmers. But the response to that cry for help was a chilling silence. No exemptions were granted. Even ordinary citizens are not safe from this spiral. 14 million Americans visit Canada every year, and they all now face currency hardships at the border that did not exist 2 weeks ago. Commuters in Detroit, Buffalo, and Seattle, tens of thousands of people every day are facing settlement difficulties that make daily life significantly harder. The Treasury banned Canada from using the dollar, but they forgot that the dollar is a two-way street. And now American companies, farmers, workers, and tourists on the other side of those transactions are paying the price for a directive they never asked for. And then the global chain reaction began. The emergency summit called by Carney convened within 10 days in Ottawa.
42 nations sent representatives, making it the largest financial diplomacy meeting since the Bretton Woods Conference.
They called it the Ottawa Agreement on Financial Sovereignty. And the three resolutions passed unanimously sent a message that Washington cannot and must not ignore. Look at the three resolutions of the Ottawa Agreement. They are not just diplomatic words. They are the blades that have cut the final binding ties. First, no nation should ever face a payment stranglehold for legitimate trade decisions. Second, the right to settle trade in any currency is an inviolable sovereign right. And third, the most critical point, the world must prioritize building a payment system completely independent of any single nation's infrastructure. But the reaction from individual powers is a true chain reaction of disaster.
India has cast aside all caution to push its rupee internationalization program to maximum speed,
setting up agreements with 18 nations in just one short week. The governor of the Reserve Bank of India said something that should make Washington shiver. India will not let its trade lifeblood depend on a system that can be weaponized at any moment without warning. And then the shock from the Middle East arrived, Saudi Arabia, in a statement that may be the most jarring of the decade, has officially accepted the yuan, the euro, and the rupee in exchange for oil. This is the first time since the historic agreement of 1999 that the petrodollar system has been shaken to its core. Remember that pricing oil exclusively in dollars in exchange for American military protection was the very foundation that allowed the greenback to dominate for 50 years. The petrodollar system did not just support the dollar. It created a forced demand. Every nation needing oil had to hunt for dollars. And that very demand is what kept America at the top of the world. Now, the largest oil exporter on the planet has boldly declared the dollar is no longer the only option. Their oil minister put it simply, "We sell oil, we do not sell our loyalty." Meanwhile, the European Central Bank has expanded its euro payment capacity by 40%, standing ready to welcome any central bank trembling at the thought of American sanctions. Even Japan, the most conservative and cautious financial institution in the world, has quietly sold off $28 billion in Treasury bonds. This is no longer a mere financial signal. This is a cry for help from one of our oldest allies. From Brazil, with a Mercosur bloc of 600 million people, to China's CIPS system, with transaction volumes skyrocketing by 340%. Everything is happening in real time. An alternative financial system is being built from the ruins of trust. And the irony is that the United States Treasury itself provided the perfect blueprint for that system by proving exactly why it needs to exist. Let me explain this to you on the largest possible scale. The strength of the dollar rests on three pillars: universal, neutral, and available. Universal means it is accepted everywhere. Neutral means it comes with no political strings attached. Available means anyone can access it freely for any legitimate purpose. These three pillars are actually one. If just one collapses, the entire structure turns to smoke. In the past, the world turned a blind eye when the U.S. sanctioned Iran or Russia because they viewed it as punishing an enemy. But when that weapon was aimed at Canada, a member of the G7, a NATO ally, a brother in the Five Eyes, with a perfect credit rating, a psychological threshold was crossed. Trust has been executed, and this time there is no miracle that can bring it back. The message sent by the Treasury is not that Canada is being punished. It is far more dangerous. It is an assertion that access to the dollar is a privilege we grant rather than a right, and we decide who gets to enjoy it. That is the most dangerous sentence in global finance, because the dollar can survive when used as a weapon against enemies. It cannot survive when used as a weapon against friends. And who are those friends? Friends are the ones holding 59% of the world's reserves. Friends are the ones conducting trillions of dollars in transactions every single day. They are the ones who saved national wealth in Treasury bonds because they believed they were safe, liquid, and unconditionally accessible. Once those friends discover that their savings can be frozen, restricted, or used for political blackmail, they will not argue, they will simply leave. Do not be fooled into thinking we can fix this. Even if the Treasury reverses the directive tomorrow, even if the President personally calls Mark Carney to apologize, or if Congress passes a law to prevent this mistake from happening again, the damage is permanent. The infrastructure of the Ottawa Agreement is being built regardless. The Saudi policy of non-dollar oil pricing is functioning regardless. The Japanese divestment is complete regardless. The alliance of 42 nations exists regardless. The CIPS system grew by 340%, and those transactions are not coming back. You can revoke an executive order, but you cannot break trust and then expect it to function. In systems theory, there is a concept called a phase transition. Like the moment water turns to ice, it does not happen gradually. It happens at a specific threshold, and once crossed, the old state is gone forever. The global financial system just experienced that transition. The old state of dollar dominance, built on unconditional trust, is dead. A new multipolar system built on hedging and diversification is taking shape in real time. And no amount of diplomacy can push water back above freezing. Buffett captured this irreversibility better than anyone else. He said the dollar did not die today, but its immunity is gone. And a currency without immunity is just paper with pictures of presidents on it. The U.S. Treasury used the same power against an ally that it uses against hostile nations. The directive was meant to punish Canada for seeking alternatives to the dollar. Instead, it gave Canada perfect reason to abandon the dollar in 72 hours. It gave 42 nations the momentum to build new financial infrastructure in 10 days. It gave Saudi Arabia the political cover to break the petrodollar deal. And it proved to the entire world that dollar access is conditional and political. Warren Buffett, the greatest investor in American history, says he can no longer guarantee the safety of the dollar. He compared this to Nixon closing the gold window. He started buying gold for the first time in decades and moved hundreds of billions of dollars out of dollar assets. This directive was supposed to isolate Canada. Instead, it isolated the dollar. The clearing systems are being built. The alternatives are live. Trust is broken, and the currency that was the pillar of the American century is now the strongest argument for leaving America behind. Keep your eyes on this, because the dollar just lost something it can never get back. And the whole world noticed.